Hello and welcome to New York Institute of Finance's NYIF Talks. Our speakers today are Tracy Williams and Jerome Wong. Gentlemen, it's all yours.
Thank you very much, Candace. I am Tracy Williams, and as you said, our topic today is corporate credit analysis and debt markets. Let's first introduce ourselves. As Tracy Williams, I spent 27 years at JP Morgan in the corporate and investment bank. In the last 10 years there, I was a managing director, for the most part in the financial institutions group. So after 27 years at JP Morgan in corporate investment banking, I became an instructor in finance. I have been affiliated with New York Institute of Finance since 2011, and I teach a variety of courses at many banks around the world, including courses in corporate credit analysis, risk management, market risk, project finance. I can go on and on. So, Jerry, you can introduce yourself.
Sure. My name is Jerome Wong, also part-time faculty at New York Institute of Finance. Currently, I'm also the program director for the Masters of Global Finance program at Gabelli School of Business at Fordham University. I've been an adjunct professor there for 4 or 5 years. My professional experience is about 16 years on Wall Street doing credit derivatives and structured credit. New York, London, Hong Kong, Chase, the predecessor for JP Morgan, UBS, Citibank, BNP Paribas, a bunch of places. So that was kind of during the boom times. I spent 10 years in technology as an engineer before that. And now also working on angel investments across many sectors. Thank you.
Okay, thank you. So one of the things that we're going to do is go over very quickly some of the topics we're going to try to cover. So we're really focusing on the impact of COVID-19, credit analysis, corporate debts, debt markets, and then how should we revise or change the way that we analyze companies going forward. So the topics we will cover include adjusting and revising credit and debt analysis in a deteriorating environment. One of the courses I do teach at New York Institute of Finance is corporate credit analysis and corporate financial analysis. And so we need to fine-tune ways to analyze corporates in the kind of environment that we are in today. We'll look at some of the responses and strategies of corporate borrowers. Many borrowers in recent weeks have already tapped into revolving credit lines and have approached banks for help. We'll look at some of the new risks faced by banks. We'll talk about updates in debt markets. That includes bank lending, commercial paper, public and private debt markets. We'll try to gauge the response and reactions from rating agencies. And we'll also identify some of those vulnerable corporate industry segments that are out there. Jerome, are there any other topics you think that we might want to quickly cover?
No, I think as we get into further details of each of them, we can provide some pretty good information.
Okay, so first question we have is, how should you adjust corporate credit and debt analysis in a deteriorating environment? So we're going to assume that many people tune in are familiar with financial analysis and credit analysis of corporate earnings, cash flows, and balance sheets. But how should we adjust that analysis as we go forward? So one of the things that I'll preface is that a lot of corporates, especially big names, Fortune 500 companies, are highly leveraged. So they spent a significant amount of years in increasing leverage on the balance sheet up until December 2019. So as we get into the crisis, we're facing sort of unprecedented levels of debt on corporate balance sheets.
Yeah, I think the number that kind of stands out to me is that corporate debt is 40%, 47% of GDP, which is a pretty high number from a historical point of view. And it's not just the number of debt, it's actually the makeup of debt. Whereas in early 2000s, triple B, the lowest investment grade ratings, was about 17% of the market at that point in time. Today, it's about 50%. So half the companies are at the triple B level that's out there. So it's much more vulnerable.
And we might want to talk about some of the trends of why companies had sort of reached these levels of debt. Some of that has to do with the confidence in the recovery since the early crisis back in 2008 and 2009. But a lot of corporates in recent years are taking advantage of low interest rates and also the advantages of highly leveraged balance sheets during the times when times are good. So highly leveraged balance sheets can lead to higher returns on capital. So this is some of the reasons why we saw this sort of sharp upturn in highly leveraged balance sheets over the years. Jerome, how about some of your thoughts about why companies increase debt so quickly over the years?
Yeah, I think, as you said, low interest rates is probably one of the easiest explanations for that. It's been low for 10 years. What happens is also the management structure for compensation is a large part of that is based on share price. So one of the easiest things to do to increase share price is actually do stock buybacks. So a large portion of the debt that was raised at the cheap rates were used for debt buybacks, which, and this was, as Tracy mentioned, well into the end of 2019. So even before the coronavirus crisis, they were actually in a very precarious situation already. So any type of downturn, especially such a dramatic downturn as we're experiencing now, has exacerbated the problem.
One of the cases I use in my NYIF credit course is I look at companies like PepsiCo and Merck. I use PepsiCo as an example. So if you go back about 10 years ago, PepsiCo had debt levels of about 10 or 15 billion. And then if you come back up to about 2018, 2019, those debt levels had reached 33 billion. And so during that period of time, as Jerome, you had just pointed out, and you want to say, what do they use that debt for? A lot of the proceeds were used to facilitate buybacks. And so during that 10-year period, the book equity on PepsiCo's balance sheet was reduced from 25 billion down to about 11, 12 billion. So we do see highly leveraged balance sheets across the spectrum. Let's focus a little bit more on the credit analysis. So in the credit analysis, I think one of the first things that we do is to try to identify some unusual risks and vulnerable industries at this time, and then try to project what we expect in terms of earnings and operating cash flows. So obviously, in the short term, we can project that for many companies, revenues are going to be declining, and it's our job as credit analysis to try to project how much they will decline over a period of time. Any thoughts that you have?
Yeah, I mean, if
Jerome, about in terms of analyzing sort of earnings and projections.
Yeah, I mean, if you look at what some of the market players are saying now for decrease in GDP, pick a number, 20, 25%, which is a dramatic number. If you look at how long it took during the Great Depression to go down 25%, it took several years. Currently, it's taking 2 months.
And so whatever the company that we're looking at in terms of an analysis, as I said, we focus on operating cash flows and revenue. So in an analytical process, with all this debt that we have on the balance sheet, we want to surge that with operating cash flow. Well, how do we generate operating cash flow? It's going to be from revenues and expenses. And so I think across the board, an analyst has to try to project or reproject what's going to happen to cash flows going forward as part of the corporate credit analysis.
Yeah, and if you look at the credit analysis for small companies versus for larger companies, the small companies have much lower cash reserves than the larger company. But if you sit there and say, okay, how much of revenues of large companies come from smaller businesses, that contagion effect may not really be, priced in yet.
And that's a very good point, as you had said, that if revenues come down, the expenses don't come down as quickly, and then operating cash flows are going to come down, we may have situations where companies will have negative or cash flow deficits. And at which point in time, it's going to be companies that have strong balance sheets and large cash reserves on the balance sheets. For many of the companies that I've looked at in some of my NYIF cases, they do have a substantial amount of cash on the balance sheet. So if we expect in the next 12 months or so that we'll have a large percentage of companies that are going to have negative cash flows, companies that do have substantial cash reserves on the balance sheet can be insulated or can prepare for this severe downturn. So many, go ahead.
I'm sorry, just had, as we were discussing this, Tracy, I was thinking about an idea which may actually help the country. If you look at the amount of cash US companies have offshore, it's about $2 trillion that isn't being repatriated because of the higher tax in the US. What previously had happened about tax holidays, where the government would say, okay, if you bring back X amount of cash, we'll give you a much lower tax rate. Unfortunately, with the idea and the expectation that they would do additional hiring, research, and expand their business, unfortunately, the results for those previous tax holidays are mixed at best. A lot of times they repatriated cash using the tax holidays to rebuy stock of their own company again. So this may be a really interesting time that we should propose to whoever can listen, that do a tax holiday to repatriate money back to the country, and using the same type of guidelines that they're using for the current stimulus package, make sure that they're not allowed to actually buy back stock with that money. The challenge is that money is fungible, so it's much more a function of how much time. And currently, I think the stimulus package says for the next year, companies receiving any help from the government can't buy back stock for a year.
That's a very good point. As I said, in the media and in the analysis of what's going on with companies right now, I actually haven't seen that. Even in 2018, 2019, I had, when I look at corporate balance sheets, I see a substantial amount of cash that's sitting on the balance sheet. And as you had said, a lot of it is overseas, but I haven't really seen any stimulation to encourage companies to bring it back onshore. As we are saying, is that companies that with high levels of cash reserves can be insulated, or they can kind of get through this crisis. Some companies, as we have noted, are going to continue to be profitable and are going to be able to continue to generate some positive cash flows. I think as an analyst, I think an analyst has to look acutely at changes in revenues, and then also look at to the extent that can companies manage costs and expenses as we go forward. When we look at credit analysis, we look at variable costs and fixed costs. So to what extent can companies decrease variable costs while keeping people employed and on the payroll, and also manage fixed costs as well? Any thoughts, Jerome?
No, I think the big variable is how much revenues can come back, and I think we can probably get into that in the later section when we look at industry-specific viewpoints.
Yeah, and that's a good point about industry, because I looked at, for example, a company like JCPenney. JCPenney is the retail industry. It's already in one of those vulnerable industries. It has a substantial amount of debts relative to its balance sheet, maybe about $4 billion. And it's not profitable. And so it's up even before this particular crisis, it was operating at a cash flow deficit, but it's only sitting on about $500 million in cash. So you ask the question, how can a company in the retail industry sort of survive this with so fewer cash reserves on that particular balance sheet?
Yeah, I think those, unfortunately, companies like that, which were already in a downward spiral because of the change in retail spending, more for the e-commerce side, this will probably close to the death knell for some of those companies.
Now, when we also look at credit analysis, we also look at earnings, operating cash flow, but also take a look at the balance sheet itself. So companies with stronger balance sheets, not just with cash reserves, but with ample capital and ability to manage the cash conversion cycle or the operations very well and operated shrewdly, can kind of get through this crisis as well. This goes back to looking at a balance sheet of a corporate. And as we had said, a lot of corporates are highly leveraged, but there are other ways that a company can get through the downturn. And as part of the analysis, we can kind of kind of guess, or not necessarily guess, but assess which companies are better at getting through in terms of managing the operating cycle. The operating cycle includes working capital, accounts receivable, inventories, short-term debt, the supply chain, and things of that nature. So, Jerome, when we're looking at the top of the balance sheet, receivables, inventory, accrued expenses, payables, suppliers, relationship with suppliers. Any other things that we think the analysis has to sort of look at very carefully as part of the analysis?
I think, the positive that generally speaking, the banks are relatively strong, have strong balance sheets and reserve. So I guess with the proper government oversight or direction, they can provide that working capital liquidity. And I think part of that will require maybe some loosening of the regulations on the banks with regard to their liquidity ratios to provide additional liquidity to the corporates.
And that's a very good point about the liquidity ratios for banks, because some banks, because of Basel III regulation and Dodd-Frank here in the US, large banks have a substantial amount of cash on the balance sheet. And that's the lesson learned from the previous crisis, where government regulators want to make sure that banks are liquid. And so in some cases, I have seen where banks are asking for some relief to reduce the pressure to maintain so much cash so they can lend it to help companies. And so at the top of a corporate balance sheet, what we see is that a company requires working capital funding on an ongoing basis. And so to the extent that it can manage and maintain these relationships and these funding sources with the banks, that can kind of get it through that sort of operating cycle.
Yep.
Another thing I think is worth looking at for an analyst is that on that balance sheet, we have accounts receivables, we have inventory. There's a possibility that you could see more delinquencies and defaults on receivables. So in traditional analysis, we kind of look at accounts receivables. That's sales that are earnings, but the cash has not been received. And there could be a situation that is a higher default rate on receivables, and analysts need to pay a little bit more attention to that. At the top of the balance sheet on the liability side, it's related to accounts payable and suppliers. And so I recommend that analysts have to understand a little bit more closely the supply chain and the impact of supplying raw materials and goods to the corporate operations. Some suppliers, we may have to be watchful, might have some credit concerns, and they may tighten some of the credit terms that they have with corporates. So instead of waiting 60 days to be paid, some suppliers might push and recommend a shorter time frame before they get paid. Any other thoughts about the top of the balance sheet?
Yeah, I mean, another strategy may be, just selling the accounts receivables, which depending on what their credit rating is, there might be a decent market for that, and as an alternative way to raise cash.
I think that's a good point. And you say, as a corporate sort of thinks through, I need cash, I have receivables, I can consider selling, factoring some of these receivables to get the cash sooner, as opposed to say waiting 60, 90 days.
Exactly.
Yeah. So I think, as part of the analysis, and we're just speaking quite broadly here, it's just operating cycles, cash conversion cycles could be impacted much more severely than normal. And I just sort of reminder for analysts to take a look at that. The other part of the analysis is looking at the bottom of the balance sheet, and that's plant, property, and equipment, fixed assets, and investments. So companies have these fixed assets to sort of to expand, grow, maintain core operations. A lot of that, of course, is funded by long-term debt and capital. And we may have some thoughts about companies' plans and projections as they manage fixed assets on the balance sheets. Do you have any thoughts, Jerry, about do we expect increases in capital expenditures, decreases, postponements, and expansion and investments?
Yeah, I think part of it will be, I don't see a big spending spree for additional fixed assets. I think depending on how their companies are affected by the recent change in the tax law, it may help them reduce their taxes. The question is, does that really matter if you have negative earnings?
So, when we look at December 2019, as I have begun to look at annual reports of companies, annual reports of 2019 did not predict COVID-19. And so many companies did have capital spending programs to grow, to expand, and also to restore and renovate. And so I expect some of that might be postponed, and I think the companies are going to concentrate just maintaining the current infrastructure at this point in time. So also, as we look at this particular balance sheet, and Jerome, you had pointed out before, I think that in many cases, we can see a suspension or a reduction in dividends that are paid out. So stronger balance sheets during this time are balance sheets that are well capitalized. And I think that, regardless of whether you're getting support from the federal government or not, I could anticipate that, again, we're going to see fewer, if any, stock buybacks, and we might see either maintenance or cuts in dividends going forward.
Yeah, if you look at someone like ExxonMobil, who has to borrow to pay part of their dividend, they're going to get under tremendous stress to actually cut their dividend, but they've been, very unwilling to do that. And with oil prices going down, as well as just overall revenues on top of that, I think they should be under tremendous pressure to actually cut the dividend, which they've been very unwilling to do to date.
Yeah, and so a lot of companies want to keep that dividend. Of course, companies also manage operations and cash flows and debt, but they also manage market value, shareholder value. And to a certain extent, I think companies are going to try to maintain that dividend as much as possible. They're only going to cut unless they actually have to. Obviously, companies that are in precarious condition will either cut, suspend, or do away with the actual dividend.
The example I used for ExxonMobil, even last year, they already had to borrow some money to maintain their dividend.
Yeah. One company that I look at for my NYIF course is Freeport McMoran. That's the copper mining firm that's based in Arizona, and it was sort of preparing for a downturn. This was a company that, when copper prices were down a few years ago, it suffered cash flow deficits, and it was sort of had issues with highly leveraged debt balance sheets. Suspended, got away with the dividend. In recent years has done better. He was trying to reintroduce the dividend. Now I think we'll go through a period where, again, they're going to be very, very cautious about reinstating that dividend.
Yeah, great.
Another thing, I think, as we go forward, when we look at a balance sheet, and we had talked about this before, is that over the last 10 years, companies achieved shareholder value. Companies took advantage of high leverage by increasing debt on the balance sheet. And so I think as analysts, as we go forward, we need to reanalyze what is a good, stable, strong balance sheet. Many of us who look at companies say that what companies did over the last 10 years ago, they achieved shareholder value from re-engineering their balance sheets. And I think going forward, we might have to reassess about what we see as comfortable leverage on a balance sheet. What about your thoughts?
Yeah, I think you can't design your balance sheet anticipating pandemics, global pandemics, but you can make it a little bit more resilient. It's just inefficient to structure your company around pandemics.
One question I think we ought to bring up here, and I get this question in a lot of my classes, is what do we consider a highly leveraged balance sheet? What is an appropriate metric? Now, usually in debt analysis, we say that we measure leverage based on debt to equity, debt to EBITDA, debt to total capital. Sometimes we use the ratio of net debt, which takes out cash on the balance sheet, and then apply that to some of the metrics. And so oftentimes we try to define what's highly leveraged. Our rating agencies have a point of view, but analysts also have a point of view. In many cases for corporates, we look at debt to EBITDA or debt to equity. And so oftentimes there's sort of that benchmark that when we get to debt to EBITDA greater than, say, 5 or 6 or 7, we say that's a highly leveraged balance sheet. You know, our metric or our thoughts about what's highly leveraged might change in this type of scenario. So what might have been a comfortable level of leverage, say debt to EBITDA equals 5, might be uncomfortable as we go forward. Anything you've seen or thoughts about that concept, Jerome?
I mean, yeah, it's just whatever coverage ratios, how well can you service your debt? Just looking at it from a slightly higher level, and that probably will change a little bit. And I think maybe just kind of rebalancing kind of the distribution of maturities for their debt to be a little more flexible.
Yeah,
I think
and I think that's a very good. Go ahead.
That's all. I was saying that over the last a few years, given how relatively flat the curve was, people went out pretty far on the curve with their financings.
And that's a very good point, because that's yet another way of looking at how much debt is on the balance sheet. And I go back to this particular chart, is we measure it based on cash flow coverage. So in this particular case, we have cash available for debt service. And then what is the debt financing payments, principal to interest? And so usually as a benchmark, we would say that ratio should be 1.2, just as a comfortable level of leverage. As I said, we're not here to say what you should do and how you should do it. It's just things that you should think about as you're looking at it going forward. I do like what you said, Jerome, about how what had happened is that if you have longer terms, longer tenors, it can take pressure off in terms of coverage from period to period.
Right, and I think to go back to a previous point, if you look at kind of the profile of the ratings of companies that have debt, there's 2 stages. When it goes from a single A down to triple B, all of a sudden they no longer have access to the CP market.
Yeah.
Okay? That's the first step. If you get further downgraded from triple Bs to non-investment grade, all of a sudden you need to have a CIO which knows how to actually finance a high yield company, because it's a different set of options for financing. So you kind of have to look at the experience of the CFO as well as the Treasury Department of how well are they able to finance themselves. Could it be a totally different structure potentially once they get downgraded far enough?
And that brings to mind also, as you had suggested, is that if a company doesn't have any debt that's due in the next 10 years and all they have to do is pay interest, that's one thing.
Right.
If a company has substantial current portions that are due in the next 5 years, that is another thing. And I think sort of to advise analysts is we need to look at what is called the refinancing wall over the next 5 years. So a company may have $15 or $20 billion of debt on the balance sheet, but what's actually due today and within the next 5 years? And as you suggested, investment grade companies, the AA's and single A's, they usually can refinance without too much difficulty. It's the company that's a single A or triple B and that just gets downgraded and it has a substantial amount of debt due in the next 5 years, they're going to have trouble refinancing that debt as well.
Yeah, I describe triple B companies. People say it's low investment grade. I say it's near high yield.